Alright, I just wanted to do a quick video, and this is actually a response video. Dennis over at TruFinancials just recently did a video on the true cost of a mortgage. And I just want to say straight out that I really like Dennis's channel. Generally, I agree with him on a lot of the videos he makes. This specific video, I don't think I agree with it for my personal circumstances, and that's what this video is going to be about. For many people, Dennis's advice in his video is spot on, so I don't 100% disagree with his video, I just disagree with it in my case. So let's get into why I disagree with his video. So Dennis used the, I think it was called the SMART asset calculator, and let me just move my screen here real quick. And he used different values than I used, but basically the gist of his video was showing how much interest you pay over the life of a 30-year mortgage, which is 100% correct. You do pay a lot of interest over a 30-year mortgage. So when the wife and I bought our house, and I put our approximate numbers in here, our house price was around $335,000. We built a new build house. Our down payment, we put down roughly just under half, about $150,000. Our interest rate, which 3.87, it was actually 3.875, but I couldn't get it to show on here. So that is a really good interest rate historically. So that's one of the reasons why I did a 30-year loan, was because it was a really good interest rate. Historically, anything 6% or under is actually a really good rate. So even today's interest rates are actually really good. So as you can see here, the mortgage over time, basically our principal paid $185,000, and our interest paid was $127,000 and some change. So yes, we are paying $127,000 in interest that if we would have put 100% down, we would not have paid this interest. But and this is where it changes in my view and Dennis's, which again, his view isn't wrong. For many people, it is 100% correct. So if I take my $185,000 that I would have put down if I would have put 100% down, and put that into an S&P 500 index fund, and say over the 30-year period it averaged 5%, which the S&P 500 index fund has averaged more than 5% over the last 30 years. So I'm kind of being conservative with my numbers here. That $185,000 turns into $992,000 and some change. So as you can see, by not putting that much down and investing that much in an index fund, I've made almost $1 million that I would not have made otherwise. So if we take that $992,000 and some change and subtract out the $127,000, by paying that $127,000 interest and investing the rest of the money, I actually made $865,000 and some change over a 30-year period. Now let's also go, so if we go to this here, and we go to, where'd it go here? Actually, I gotta move the screen 1 second. Sorry, gotta resize here. So if we go to the 10-year average appreciation rate, and I can't actually get it in the screen here, but as you can see, the 5-year average appreciation rate is 4.52%, which seems kind of high just by going by my gut feel of the area. The 10-year, which I can't get on the screen right now, but the 10-year is 2.98% according to this website. So again, going with more conservative numbers, I put in 1% appreciation, which I think is probably accurate. I live in just outside of Buffalo, New York, so it's not known as a high-flying area for real estate appreciation. So my house, say $330,000, at 1% appreciation, over 30 years, it'll roughly be worth, say, $758,000. So by, and this calculation here is really irrelevant to the discussion, because whether you put 100% down or 50% down, you're still going to get the appreciation. But back to my original premise, by not putting that $185,000 down as 100% down payment combined with what I actually put down and what I didn't, that I invested, I'm making more money than just by throwing that and having a zero mortgage, no mortgage borrowing whatsoever. Now, where does my argument maybe somewhat fall apart? I would say it falls apart when you take into account risk. So with my investing philosophy or investing theory here, I'm not accounting for risk. So there is risk by not putting 100% down. There's risk that I use numbers of a 5% S&P 500 index return over the 30 years. Say, over 30 years, maybe, it's unlike historical trends and we get 2%. The numbers still work out in my favor, but there is a risk there that those investment returns don't hold true. There's also a risk that, say I lose my job and I can no longer afford my house. Is that a big risk? For some people, maybe. If you have an emergency fund, if you have that $185,000 sitting there, or more than that, which in my case I do, I could pay off my mortgage and still get a decent investment return. So there is some risk there, and if you don't generally have a lot of money to your name, I would agree with Dennis that maybe you don't want to take out a big mortgage, or if you're in an industry, say you're in an industry that isn't known for having job stability, and maybe there's not a lot of high-paying jobs in your area. Again, you may not want to take out as long of a mortgage. You may want to put 100% down. So at the end of the day, there is no real 100% right answer, and I don't 100% agree with Dennis, but in my case, that's why I did not put 100% down. Alright, I hope you enjoyed the video, and I will put a link to Dennis's original video that I'm responding to down in the description. Subscribe to my channel if you like these kind of videos. I mostly do investing type videos, not so much mortgage and personal finance. Dennis's channel is really great if you want more information on personal finance. So head over to Dennis.